Okay. And my inventory, I expect an increase to my inventory because I'm going to be carrying fruit now. So let's say I expect, let's say $2,500 of inventory, and then $7,500 of inventory, and then $12,500 of inventory increases. Okay, in other words, I plan on having more and more cost of inventory at the end of each year. Okay, so over here on my balance sheet, I want to subtract that amount, and again, I'm back in balance. Okay. Okay, so we've taken care of our accounts receivable, prepaids, and inventory. Now let's look at our property, plant, and equipment. So um, over on our cash flow, if we purchase new equipment, that's going to be a negative cash flow item. So I'm going to make that negative. Or if we sell any of our property, plant, and equipment, that's going to be a positive cash flow item. Okay. For right now, let's assume that nothing's going to happen with that we're not going to buy any, we're not going to sell any. But I'm going to build the spreadsheet so that if later I wanted to put that in, I could, and it would take care of it. And over here on my balance sheet, already I'm subtracting my depreciation. I also want to subtract my purchase, which is a negative number, which would therefore be adding it, or vice versa if it was a sale. Okay, and so now if I made a change here, just watch. Let's say I did decide I wanted to purchase $10,000 worth of equipment. When I hit enter, watch what happens right over here on my balance sheet. I hit enter now, and you can see my cash went down, my property, plant, and equipment went up, and I'm still in balance. Okay, so in fact, we'll just leave that there. We'll just pretend like we did want to purchase that anyway. Okay, so now I've got my asset side squared away. Let's look at the liability and equity side of things. Okay, so let's start with accounts payable, and I'm going to go increase / negative decrease in, and we have accounts payable. If we had other current liabilities, we'd want to put those here also, but because I made my balance sheet pretty slim so that I could do this example for you without a whole lot bogging me down, I just have the one item. Okay, so it's going to be the same kind of thing except opposite. The reason that it's an increase here is because if we purchase something and don't pay for it, that's going to be an expense, which is going to reduce our net income, but we don't have any cash flow that's affecting us, so we want to add it back. Okay, so let's say that I expect that my accounts payable is going to grow by $1,000 a year as my business is growing. So I put in my thousands there, and on my balance sheet, you can see that's put me out of balance. So what I need to do is go to this accounts payable, and I'm going to be adding that back in because as we're saying this is an increase in my accounts payable. So it's made my accounts payable go up, and it's made my cash also go up, which keeps my assets equal liabilities plus owner's equity in balance. Okay, so then the next thing that we have here is the loan payable. If we borrow money, it's going to be a positive cash flow item. If we repay the loan, it's going to be a negative cash flow item. It's possible your company will have multiple loans. And I'm just going to say zeros on there. I'm not going to plan on borrowing more or repaying more. Once I see what my ending cash balance looks like, maybe I'll make a change there. That might be something that, that the financials drive my business plan a little bit on my repayment plan. Okay. Over here on my balance sheet, I need to make sure I fix that formula. So I'm going to go minus the loan payable amount, even though it's zero. Okay. And I stay in balance. Looks like I need a little bit more room over here on my cash flow, so I'm going to insert some rows, and the next thing that I have here is my capital stock. So if I issue capital stock, that's going to be a positive cash flow item. I don't plan on it in my business plan, so I'm making those zeros. But over here, what I want to do is make sure that my formulas and my balance sheet are taking care of it in case I do. And remember our retained earnings. We've already taken care of what makes retained earnings go up, the net income. Now what we have to do is worry about what makes it go down, and that would be if we pay any dividends. If we pay dividends, that's going to reduce my cash, and it's going to reduce my retained earnings. Okay, so let's say I plan on paying $500 of dividends. Okay, so over here on my retained earnings, I also want to go plus the retained earnings, or the dividends to my retained earnings, and there you can see I stay in balance. Okay, so at this point, I should have everything that I need taken care of on my cash flow for adjusting my balance sheet. Looks like I inserted maybe a few too many rows, so I'm going to go ahead and delete those. And now I just need to copy some formulas across and then do some formatting, and I should be all set. So my net income and my depreciation, those are formulas that are pulling the numbers from my income statement, so I'm going to just pull those guys across. And down here, my change to cash is just a formula, adding up those numbers from above, so I'll pull that across. My beginning cash was coming from the balance sheet, and that should still work, so I'm going to copy that across. And my ending cash is a formula adding my change to cash and beginning cash, so I can pull that across. Let's go ahead and do some formatting while we're here, and then we'll move over to the balance sheet. I'm going to take and highlight all of these numbers here, and I'm just going to apply the comma format with no decimal places. And it probably makes sense to put some borders just to make this look a little bit nicer. And I think that's good enough for what we're doing. Over here on my balance sheet, everything here was a formula. So all I've got to do is drag that across. You can see I've stayed in balance, which is good. It looks nice. And you can see that, for example, my ending cash at the end of 2012 is the same as my cash balance on my balance sheet at December 31st, 2012. So now any changes I make here, for example, it looks like in 2010 I've got $46,000 of cash. I also owe $40,000 on this loan payable. That doesn't make much sense. Why would I keep a loan paying interest on it and all that when I have cash that can pay for it? So I'm going to go here to my loan payable, and I'm going to go repay. So that's cash going out, so it's a negative number. Maybe I'll repay 20,000 of it here. Okay. Maybe I want to hang on to a little bit of cash in case I need it. And then in the next year, it looks like I can pay off the rest of it. Okay, so you can see now I've built a model where I can make some modifications to my business plan based on the results of the financials. And that's pretty much how you keep your balance sheet in balance and how you complete your forecast for a business plan. Of course, yours will probably have more detail to it, but it's the same process. Once you understand this, you can add as much detail as you want. Some of the things that maybe a bank or an investor might want to see that aren't included in here that perhaps you'd set up as a sub-schedule would be, what equipment do you plan on buying? And maybe you'd have a subsidiary schedule that covered that, or it would at least be discussed in your business plan. You might want to discuss stuff like accounts receivable and how are you going to manage that? How are you going to keep that from growing to be such a big number that you're not collecting the money on a timely basis? Those are the types of things that you'd either have subsidiary schedules for, or that you'd build into the text of your business plan. I hope this has been helpful. Feel free to watch it as many times as you want, and good luck on your plan.